So right now, it gives me great pleasure to introduce Joe Friedman, my colleague from Rystad Energy, for the next segment, where he will talk to us about tapping into the new FPSO market, the opportunities in a changing energy market. A little bit about Joe. He's our Vice President for the Energy Service Research in the rigs and vessels. And he's got a master's degree in economics with research distinction from the Norwegian School of Economics, and also spent some time in Yonsei University and also in the University of Melbourne, where he got an award in Norwegian University of Science and Technology for mathematics. In his spare time, Joe is a keen triathlete. I have had the distinct pleasure of racing with him before, but whereas he's in the podium, I am one of the ones who finish at the very end. So with that, Joe, over to you for what would be the last presentation for today.
Okay, thank you, Vijay. Okay. Okay, hopefully everyone can see my screen and hear me okay. So good afternoon, Singapore, and hello to everyone listening online.
We can hear you loud and clear.
That's good. So for today's agenda, what I was planning to talk about is some of the opportunities we see arise now as oil companies are seeing record high cash flows. After that, we're going to review some of the cost development trends in deep water offshore, and also share some of our views on how costs should develop going forward. Then, since the theme for the Congress is related also to the energy transition, we want to show a scoring model we made in Rystad Energy on how likely it is that service companies are going to succeed in the energy transition. So that will be the last point. So first, as you know, the Brent price is now currently trading above 70 USD per barrel, and given the uncertainty in the market, also investment levels is quite low, meaning that with high revenues and low cost, we expect to see record high free cash flows in 2021. And as shown in this chart, we expect around 350 billion in free cash flow to fill the pockets of publicly traded E&Ps. So the low investment levels, both seen last year and this year, have obviously made it challenging being a service company, but historically there has been a strong link between free cash flow and activity levels, which means that we expect to see more spending and a better outlook going forward. And already this year we have seen a comeback in new projects being sanctioned, which I will come back to in the next slide. But one thing I want to highlight before I do that is that looking at the revenues, the FPSO industry has actually done quite well during the challenging COVID times. So total revenues from companies within leasing out FPSOs actually went up with about 9% from 2019 to 2020, which is quite in a contrast to what many other service companies have experienced over the last year and a half. So this slide shows sanctioning activity, but it's shown in greenfield CapEx by award year. Yes?
Hi, it's Vijay. Sorry, we can't see your slides. Can you share your screen, please?
Okay, and it shows, for me, it shows that I'm sharing my screen, so just give me 1 second. I need to try again. How about now? Is it the slides back?
Yes, now we can see the slides. Thank you.
Okay, yeah. Vijay, please let me know if the slides disappear again. We reconnect. Okay, so what we're looking at here is the committed greenfield capex, and this year we expect 10 projects to be sanctioned. This will add up to around 14 billion in committed greenfield capex. And also going forward, we see that we have quite a positive view on sanctioning, and we expect around 11 billion USD to be committed on average per year. I think one of the key takeaways here is that, as you can see from the chart to the right, is that South America is going to be a very important region and a key driver for the demand. And within South America, Brazil is the key market. Other regions to highlight there also is UK and Norway, then West Africa and Asia as kind of the third runner-up here. Looking into the specifics for Brazil, 5 FPSOs has been sanctioned this year. We expect 5 also next year. And between 2022 and 25, we expect 13 more projects to be sanctioned. Some projects to highlight this year is Búzios 6 and 7 that was awarded by Petrobras. Also Equinor awarded Bacalhau, which is a large FPSO. And also you see going forward, we expect Petrobras to be the kind of key operator in terms of sanctioning FPSOs. And then we also see some of the other oil companies here that are looking to develop projects using an FPSO. In this chart here, we're looking at upstream investments by different supply sources. So offshore, shale, and conventional onshore. I guess the overall trend here is that upstream investments will find it a little bit hard to recover back to 2019 levels. It's been 2 years of low sanctioning, and there's a lead time between sanctioning and spending. But on a positive note, offshore is the market where we see growth coming back the quickest, and deep water is kind of the main growth in offshore. So, and one reason for that is that offshore deep water has turned out to be a very competitive source of supply, which is a good leadway to the next topic in my presentation here, which is reviewing cost development trends in offshore deep water. And as I mentioned, offshore is a very competitive source of supply. This chart here shows the cost curve for a potential supply that has been sanctioned over in 2020 and what we expect to be sanctioned towards 2025. And one country that kind of separates itself from the rest here is Brazil, which has abundant resources at very favorable break-even prices. You see a large share of the production is with a break-even price below 40 USD per barrel. We also see more newer offshore regions like Guyana here also have very favorable break-even prices, and Exxon has sanctioned a lot of projects in Guyana that will use FPSOs. And according to our data, around 90% of the FPSO projects being sanctioned in this time period will have a break-even price below 50 USD per barrel. Jumping over to the OPEX side. So this chart shows the overall development in OPEX per production and how it has developed from 2013 to 2020. So in general, the deepwater OPEX per barrel has come down in most regions, but maybe most impressively in South America, where it has come down more than 50% over an 8-year period. So there's several reasons for this. Brazil is the key market. So one reason is, this is from an operator perspective, an oil company's perspective. So shifting from leased to owned FPSO has helped to bring this down. But also, I think quite impressively is that Brazil has managed to increase its oil and gas production in this time period, even though activity and spending has been quite low. So that is what I'm going to investigate in this next slide and show how that's been possible. So actually, it's a general trend in offshore that production has remained quite stable, even though activity and spending has decreased quite significantly since during the downturn. So the dark blue line here shows the wells completed in 2014, from 2005 towards 2019. In 2014, the average ultimate recoverable resource for the wells was around 10 million barrels of oil equivalents. This has increased with 30% to closer to 13 million barrels of oil equivalents, and that is a 30% increase in average well performance. So basically a higher productivity from the wells. And what we also see here in the light blue line is that the cost reduction for the average well cost per barrel has gone down significantly. So from 2014 to 2019, we've seen a 60% reduction in well cost per barrel. So then, over the last 2 days, there's been a presentation about new technologies and standardization and ways that has brought costs down. So, but one thing I just wanted to highlight, which has been helping to bring costs down, is that the Chinese yards are now, being a low-cost provider, are now dominating in the FPSO space, and they're almost involved in all FPSO projects. So from the beginning, mainly doing the whole construction, where they have a very significant share of the market, they're now doing more of the work also and the other type of the scope. So having a quite significant share on the topside module fabrication and also the topside integration. So that is another way why we've seen costs come down in the FPSO space. But for the next slides now, I'm going to highlight some of the reasons why we could see cost increase already this year and also going forward. We already seen an increase in labor cost, and we have seen an increase in raw material cost. And what we're seeing in this chart is the increase in steel prices. So if you're building FPSOs, obviously steel is an important input factor, and that is something that can bring your costs up. If you're thinking from an oil company's perspective, we would also expect this year and going forward to see higher service prices. Another market that we're looking into closely is the offshore rig market, and there we have seen this year day rates for more high-spec drill ships has increased quite significantly from around 200,000 per day, and now we're seeing rates being signed above 300,000 per day. And when it comes to the FPSO market, or if you're leasing an FPSO, you could also potentially see costs increasing going forward. And one reason for that is what we see in this chart, is that there is a large backlog of FPSOs under construction, and very few new builds that was delivered last year. And we are now seeing a strong demand recovery, as I showed with the sanctioning chart earlier. And we also therefore see a risk of supply shortage of FPSOs over the next years. This chart here shows the increase in backlog of leased FPSOs, and it just shows that how many units it will increase based on the current backlog. From 2018 to 2022, that's 13 additional units that will bring the number to 20 leased FPSOs on order. And we have already actually seen a supply shortage in the market for very large leased FPSOs, most notably with Petrobras' decision to enter direct negotiation with SBM Offshore for the Buzios 6 FPSO, where Petrobras informed the market that SBM Offshore was the only supplier that currently had the capacity to deliver such a large, complex vessel. And there's still a strong demand for these large FPSOs over the next couple of years, which is, and therefore it's expected that supplier capacity will be kept low and prices high. Just to highlight that point, by looking at the backlog for MODEC and SBM, the two biggest FPSO suppliers, and they've been very successful in winning new contracts over the last years. and this will bring the combined backlog actually to the highest level ever recorded. And you see especially MODEC will have a really high backlog in 2021 based on the current order intake. So with more sanctioning, this chart will increase. Then over to the last topic. So I'm going to try to rank the FPSO industry against other service sectors in the likelihood of succeeding in the energy transition. So Rystad Energy has developed a supplier scoring model to assess suppliers' likelihood of succeeding in the energy transition. And here we are covering more than 100 different service suppliers. And we are looking at 5 dimensions and scoring them from 0 to 5 in each dimension. And I will do a case example where I go through these five dimensions in the upcoming slides. But based on our at this selection of more than 100 service companies, we see that around 12% of the companies are scoring below 10, which will put them into underperforming. And then 10 to 15 will be more neutral. And then if you score above 15, you will be overperforming. So that's kind of the result when we run this scoring model. So the first point here that I want to highlight is oil and gas positioning and renewable positioning. So suppliers that are exposed to fast-growing segments and also regions where we see growth in both oil and gas and also renewables will get a higher score. From an oil and gas perspective, it's important to have a stable revenue stream from your core business in order to also do well in the energy transition. So that's why if you're an FPSO company that has a lot of your revenues from South America that we expect to be a growth market, then you will get a better score than, for example, a rig or vessel company that mainly do business in West Africa, where we don't see the same growth potential. Also, having footprint in several renewable markets are good, and we have a forecast on the growth in different renewable segments. So as you can see here, offshore wind, for example, has a stronger growth than geothermal. And then if you're mainly exposed to offshore wind, you will get a higher score. And the scoring is also based on what type of company you are. So see some service companies have higher growth in offshore wind compared to others, etc. And the growth here are the compounded annual growth rate from 2019 to 2030. Also, financial performance is important. In this case, we have looked at metrics as EBITDA margins and debt to asset and cash flow to sales ratios. And we looked at the financial performance for the companies over the last 3 years. So just one example, if you're a company with a high debt to asset ratio, you're maybe not in the best position to take on energy transition. So then you score lower than a company that typically has lower debt to asset ratio. Then some oil and gas suppliers have now become truly diversified with activities across the full spectrum of energy services. So we analyze supplier strategies, M&A activity, joint venture, alliances and partnerships with particular focus and emphasis on renewables. So this is related to company action, and here in this chart we have shown a couple of examples on companies that has kind of gone into alliances within the renewable space. And for example, a company like Saipem we see here, they're both in wind, hydrogen, CCS and solar, which is then giving them a high score. So the more active suppliers, the higher the score in this at this point. And then the last dimension is service adaptability. So how easily can a company's product and services be adapted to the new energy markets? More adaptable offerings are scored higher. So engineering services are easily adaptable to new markets. And in the case example of FPSO companies, you know, the mooring experience is very relevant for offshore wind. So here we have shown some examples from SBM, MODEC, BW Offshore and Yinson. So many of them are in floating offshore wind, and Yinson has done acquisition both in solar and onshore wind. So here again, the adaptability is related if your technology can be used in renewable services. So the result is shown in this chart. Each bar represents one company, and we group them by these segments. As you see, EPCI surface, EPCI subsea, operation maintenance, wells and seismic, and rigs and vessels. And I guess the main takeaway here is that EPCI subsea and EPCI surface suppliers, they rank typically the highest, and they do well actually through all the 5 dimensions, in particularly renewable positioning, while companies that are typically in wells and seismic and rigs and vessels, they typically underperform, mainly due to weak positioning in renewables, and also low degree of service adaptability. So if you're doing well intervention or if you're drilling offshore wells, your adaptability into new markets is more limited compared to an EPCI company. Then I've highlighted the FPSO companies, some of the FPSO companies here in light blue. In general, the FPSO players, they score relatively high. Here's mainly the companies that do leased FPSOs. They score between 13 and 16. So that will put them in the group of neutral or overperforming. Generally scoring high, but what brings down the score is that the services aren't as adaptable in the energy transition as pure EPCI companies, for example. It's mainly relevant for offshore wind, as we mentioned earlier. And also some of these companies are very low in terms of revenues from renewables currently, more in the R&D phase, compared to many other service companies that have come much further in developing within the renewable services. So that will bring down the renewable positioning score a little bit. So that was my last slide for this presentation. So thank you everyone for the time, and if there's any questions, then feel free to.
Thank you, Joe, bringing us home with the final presentation. Very interesting chart and analysis around the scoring of the different companies in the different sectors and how they, how they look from our perspective. It's not a black box, so if you want to dig deeper into that, by all means, reach out to Joe or myself. I think we have time for one question. Joe, can you see the question? No?
No, I can see the question.
That's fine. Let me just read it out to you.
Yeah.
What does the OPEX in deep water OPEX? What are the different constituents? What makes up the deep water OPEX? I guess it's more of a methodology question. As some of the numbers in Asia. Yeah, could you just walk us through that? I think you had a slide on that deep water OPEX numbers.
Yeah, sure. So what's included in the deep water OPEX? So I guess it depends a little bit what we include there, but it's actually quite a good question. Everything, I don't have on top of my mind what's everything that's included in OPEX, but usually OPEX is reported by the oil companies. So we take all the annual OPEX numbers and we put in, we take what the companies report, and then we separate that into the on an asset level, break it down on asset level, and group it into offshore. So that's how we do it, we have a detailed breakdown on what type of costs that could go into OPEX. So we're happy to share that with the person that asks about that question. But it's mainly taking what's reported by the oil companies and then breaking it down to the asset level and then into the offshore space.
Yeah, and if I can add to that, it would be for the full life cycle of the asset. So not just for whenever the PSC may expire, especially in Asia Pacific, where we're dealing with a lot of expiring PSCs as we speak right now. So
yeah, so it's, I mean, maintenance is obviously an important part of the cost, and I think it's important to highlight this is per barrel, so it's OPEX per barrel, right? So if you have old maturing fields, they typically require quite a lot of OPEX. So I guess that's kind of the tendency is that in Brazil you're moving towards more newer production, you know, new FPSOs coming online that will bring down the OPEX, while in Asia you typically have older fields that requires more OPEX. So that's kind of the reasoning for that trend development.
Do we have time for, yeah, okay, one more question, I guess. It seems we've got one more question, Joe. Maybe we'll take the second one here. Let me paraphrase that. You know, the returns on renewables versus traditional oil and gas ventures is perhaps not the same. You know, how do we use this in that comparison that we did in terms of ranking companies and their viability through the energy transition?
Yeah, in terms of profitability, so I mean, this is quite it's not very advanced. It's a kind of a framework to help you to score an industry or a service segment against the other one. So the kind of the profitability is not something we have taken directly into consideration. It's more how we see the growth in the specific segments in terms of activity. So the scoring is more based on how much, you know, how much work do we see in offshore wind or how much activity we see in geothermal, not as much on what we see as the profitability for a service company within that segment. So
also taking into consideration debt to equity ratios and so on. So but do reach out to us. We're very happy to elaborate more on that scoring mechanism. If we have another 1 minute, I'll just say, you know, maybe your last question would be, what is the future market share for FPSOs and in terms of new developments? What do you see that? How do you see that going, Joe? Yeah,
so we see that FPSOs are kind of when it comes to sanctioning, the preferred development solution by operators in the deep water space. If we look at, we did analysis where we looked at the discoveries that has happened after the year 2000 and how much production that will end up with in 2030. And for deep water, that is 10 million barrels per day. And 45% of that production will come from fields utilizing an FPSO. And then you have 55 with other facilities. So absolutely a very dominant type of facilities that will be used by operators.
Okay, with that, I think we'll let you go, Joe. Thank you very much again, and a warm round of applause for Joe Friedman, VP of Rystad Energy.
Thank you.
Okay, so that brings us to the end of day 2 and also the end of the FPSO World Congress. We've I think, you know, I've personally learned a lot today, and we've heard from industry leaders and peers and experts and subject matter experts, you know, like Ide-san and Mikhail and Louis-Philippe Yambigo, Dr. Aya, our colleagues in the banking sector, and of course my colleague Joe talk us through quite a myriad of innovative new ideas, approaches that the FPSO industry is embracing as it heads towards a more low carbon and low manned industry, as we head towards this journey on this net zero by 2050. Now, the FPSO industry, I think, is obviously a very global industry, and it has to deal and embrace the global challenges that is beset upon us through this net zero emissions. And I think, it leaves me, after hearing all of our, the peers and colleagues in this industry, leaves me very confident that we will be able to embrace this challenge, take it on, and actually, benefit through the hard work and the innovation that is coming through from all the individuals in this organization. And one of my mentors very early on in my career told me that if you or any of the organizations that you work with just focused on people, the planet, and the profits in that order, you will always be successful. And I think we heard from all of our industry colleagues today that that's been the priority now, and that will definitely set them up to be successful from here to 2050 and beyond. So let me just draw on a quote from Darwin, and who said that it is not the strongest of the species that survives, nor the most intelligent. It is the one that is the most adaptable to change. And so I think we all have heard today how adaptable the FPSO industry is globally to change, and we will be very successful as we embrace the change. So with that, I would like to draw the Congress to a close, and thank you all very much for staying on for the full day today. It's good to see everybody back in the auditorium, and for all of you who have dialed in globally, thank you very much for staying on. It's been a real pleasure, and I want to thank Jamie and the IQPC team for giving me this privilege. So once again, thank you very much, and I now hand you over to Jamie.
Thank you very much, Vijay. And once again, a huge thank you to all our sponsors, partners, speakers, and all of you for joining us today. To be very honest, at the start of this year, we had no idea if we could run this Congress in person. So even though it is not like what it was before the pandemic, I believe it is a start. And we are definitely planning to bring the pre-pandemic glorious days of the FPSO World Congress back to Singapore next year. So let's keep our fingers crossed that all of you dialing in virtually can join us in person in Singapore next year.